I want to say is IRS tax law in many instances follows this pattern. Here's the law, here's the rule, here's the exception to the rule. Make sure that you ask them, okay, what's the exception to the rule? Because 99 times out of 100, there's going to be an exception. Okay? Because you're the employer and the employee at the same time. That's 15.3% on top of your income tax. So if you've got a, can you grab me some water? If you're already in a 12 or 22% tax bracket, that profit and loss is going to get taxed at 37%. Because you're paying self-employment tax on top of your income tax. That's because it's 100% earned income. There's two different kinds of income. There's earned income and passive income. So earned income is taxed three different ways: income tax, Social Security tax, Medicare tax. Passive income is only taxed for income tax purposes. It's not subject to self-employment tax. Okay. Examples. A W-2 is earned income. If you or your spouse or someone you know has got a W-2, you can look at it. Box 1 is how much federal income tax wages you had. Box 2 is how much did they withhold. Box 3 is Medicare, Social Security taxes, Social Security wages. Box number 3 is Social Security taxes. The cool thing about the W-2 income is that the Social Security tax and the Medicare tax is only half. The other half comes out of the employer's pocket. As a 1099, you're responsible for both sides. Okay. Passive income, interest you earn at the bank, dividends, capital gains, rental real estate is passive income. Basically the difference is, are you actively engaged in the production of that income? If you're a W-2 employee, you are absolutely 100% actively engaged in the production of that income. Okay. If you're a real estate agent and you're getting paid on a 1099, you are 100% actively engaged in the production of that income. Okay. With an LLC, your stick figure grows legs. Okay. At the perfect place, it grows legs. So it gives you the ability to allocate how much you want to go to earned income and how much you want to go to passive income. And that's how you save taxes, because versus a Schedule C, because 100% of your profit from a Schedule C, like I said before, goes to self-employment tax. But only the earned income portion of the LLC income goes to have to pay self-employment tax. So that way you can save 15.3% taxes on whatever you can allocate to passive. Okay. And there's a couple of different ways you can do that. Your LLC can be taxed as a partnership. If you're married, you can have your spouse be a partner. And your spouse, since they have nothing to do with your real estate business, they are automatically pigeonholed into becoming a limited partner. Limited partners are not actively engaged in the production of the income that's generated by the partnership. Follow me? Does that make sense? So whatever allocation, and this is just numbers on a piece of paper. This has nothing to do with cash. Okay, these are just numbers on a piece of paper. So whatever allocation that they get from the partnership income, you've automatically saved that much in self-employment tax, okay? So that's why you would want to set up an LLC, because it gives you a different structure to operate from, tax-wise. Also, an LLC can add another layer of liability protection, but that's more in the purview of a lawyer. I'm not one, so don't take anything I say as legal advice. But that's where it gets its name, limited liability company. How can we save taxes? Just in general, what I tell everybody is that the biggest loss of deductions is not capturing the data. Are you capturing everything related to your business as far as business deductions? Okay. One of the things that would help you a lot is to have a separate bank account for your business. That way you can track everything that goes through that bank account. But there's still going to be things that you're not going to be able to run through that bank account that are deductible. Biggest deduction I can think of that's not going to run through that bank account is your mileage. How are you tracking your mileage? They have apps for that. I've heard of Mile IQ. It turns on whenever you get in your car, it turns off when you get out of your car, and then it says, hey, Mike, you just went 23.4 miles. Was this a business trip or a personal trip? And you just swipe one way or the other. And it'll print out a report for you at the end of the year. Total miles you drove, how many business miles you had. Yeah. Mile IQ. I think QuickBooks has an app that tracks mileage. I think the first 40 trips are free for Mile IQ, and then they charge you $5 a month, maybe. That's just something that's not going to go through your bank account. For 2022, your mileage rate's 58.5 cents a mile. 10,000 miles is very conservative for real estate agents. That's $5,850 of tax deduction. Don't miss out on that. Don't forget your cell phone. Anything that you use as a tool to do your job is tax deductible. If you're at home and you have to use your internet to do your job, that's tax deductible. If you're sharing a line with the spouse, or you've got multiple kids on this line, I would take the total cost for the year and then divide it by how many people are on the line. A lot of people will just take the total cost, be done with it. But having gone through an audit and done that calculation beforehand, it turned out a lot better for my client, who wasn't a client before they got audited. They got audited and they realized real quick, I need somebody real to do my taxes on this one. Yeah, this kind of goes into the point where it says deductions come from several sources. So it's not just going to come from your business bank account. It's going to come from your personal bank account. We don't do a lot of this anymore these days, but some people still use cash. If you're going to use cash, even if it's a tip or whatever it is, if it's Starbucks, find some way to capture that data. Because I'm going to tell you, over 12 months, it's going to add up. Yes, ma'am. Zelle. Can you log onto your account on Zelle? I don't use Zelle or any of that other stuff. But can you log onto your account and get a printout of what all you sent? That money that you send to Zelle's got to come from somewhere, correct? From your regular bank account? From your business account. So that's where you can capture the data is from your business bank account. Yeah, of course.
So you are paying somebody for their service. So they're going to send you an invoice. So you need that invoice. That's your record. And then you can sell, correct, Mike? Because you have to keep track of who you pay, because if you pay them $600 or more a year.
And on, if it's services, like if you're paying a stager to come in and stage a home, and you pay that one particular stager more than $600, you may have to send them a 1099 at the end of the year. Yeah, so having brought that subject up, this is my advice. Before you do business with anybody like that, make sure you get a Form W-9 from them. It's an IRS form. You can download it from their website. You give it to them, they fill it out, give it back to you. You keep it. Okay, but basically a W-9 form lets you know who you're paying.
Yes, absolutely. You need to get a W-9.
Staging, photography, contract to close. Yes. No. You need to make sure you have one on file. If they don't automatically give you one, you need to send it to them and they fill it out and send it back to you. Because you don't know who you're paying. You don't know if you're paying somebody on their social security number, or do they have an EIN that they're operating out of? You don't know until you get that W-9 back. Okay. Okay, I'm talking about whenever you get ready to go, have to send them a 1099. Right, at the end of the year, you can, but you need to have that W-9 to know how to fill that 1099 out. Yes, irs.gov.
For instance, at our business, we operate out of a house. So we have a lawn care person. Okay, lawn care person has to give me a W-9 because we pay him more than $600 a year. So at the end of the year, we send him a 299. If he cannot give me a W-9, I do not use him. Services. But what is that little rule if you don't,
So if they don't give you a W-9, then you're supposed to withhold taxes on their behalf. 25%. Okay. Anybody you're getting a service from. Okay, so who do you send a 1099 out to is going to be determined based on the W-9 that you get. All right, so you send 1099s out to individuals. So when they fill out the W-9, there's not going to be a business name. It's just going to be their name and their social security number. You're going to have, and their address. You're going to have all that for the 1099. Okay, you need to send a 1099 to somebody that's operating out of an LLC, but it's being taxed as a partnership. You got to send them a 1099. You don't have to send a 1099 to corporations or S corporations or LLCs operating as S corporations. Okay. Like I said, you don't know who you're paying. It could be Joe Smith. And when he takes it down to the bank, he puts in his business bank account and it's Joe Smith LLC, blah, blah, blah. That's why you need the W-9 to see if you need to send him a 1099 or not. Okay. Any other questions about that? Any questions about? How do you keep track of that?
I asked for an invoice.
Give me an invoice, I'll shoot you the money. Yeah, it doesn't have to be fancy.
You want a record of everything, there's never get audited. Bank statement is not a record.
If you choose to set up an LLC, you absolutely have to have a separate bank account to operate that LLC out. Setting up an LLC and operating out of your personal account is not going to work. And the IRS will just absolutely flip out on you if you do that. And they'll find out if they audit you. Okay, so that's very important. Now, our situation is that Holly has an LLC. It's called Robideau Property Group. And we bank at Comerica. Her commission check is made out to her personally. Comerica doesn't have a problem with depositing that check that's made out to her personally into her business bank account. But other banks do have a problem with it. They won't let you do it. It's almost by branch as to if they'll allow you to do it or not. Every bank's different. It's almost down to the branch level. So if you have that issue, there is a workaround where you go down to the county, you get a DBA, Robideau Property Group, doing business as Holly Robideau. And you take that down to the bank, the DBA, they attach it to your account and you'll be able to deposit your commission check into your business bank account. Okay. Does anybody have a question about that? Because apparently I say that so fast most of the time that it gets very confused. It's very confusing. And you're able to deposit it in your business bank account. So you don't have a problem. We don't have a problem. But some people have a problem. Bank of America may, and it may be by branch, but they're that Chase, those big ones. Yeah. Okay. How to split commissions. If you're going to split a commission, the best, easiest way to make it work is that the broker splits it and you get your part They cut you a check for your part and they cut whoever you're splitting it with their part. That way it goes on their 1099 and you get only what goes on your 1099 to report for income. That's the best way to do it. Otherwise, if you're gonna get the whole check and then you have to give them piece, okay, then what do you need? You need their W-9 because you're gonna end up having to send them a 1099 at the end of the year. That's an expense for you. So, but your 1099 is gonna show a gross commission. And then we can, if you split it, then, you're just going to show that split part as an expense. Because you basically have to report your 1099 at minimum, that is your income. And I always like to report things gross myself. Because in an audit, what the IRS, the biggest question the IRS has, and this covers 95% at minimum of your audit, are you reporting all your income? That's their biggest nut to crack. They may ask for information about this and this and this and this. I'm going to guarantee you I've been through 2 or 3 of them in my 20 years. And the first thing they're going to hammer is, are you reporting all your income? How do they do that? Mr. Taxpayer, we want you to bring us a copy of all your bank statements. And any deposit you make is income unless you can prove otherwise. Quick story. A young lady used to work for a company as an employee. She was outside sales. She would go around and around and around making sales. And at the end of the month, she would submit an expense report to her employer. Her employer would reimburse her for all of her business expenses, her mileage, meals, whatever it was. She got audited. They claimed all of that was income, all those reimbursed, because she deposited those in the bank. They claimed all of that was income. And she had to pay taxes on it. Why? Because she never kept a copy of her expense reports. And the company was already out of business by the time she got audited. Sad. And feel free to ask any questions at any time. Certainly. What would you like to add?
Okay, so like I am a bookkeeper's nightmare. Okay, I'm just gonna tell you that up front. Because we have Robideau CPA, I have Robideau Property, I have individual bank account, we have another bank account for another little company. And all these little cards are the same, okay? So, and most people I know today do not balance their checkbooks. Okay, and if you don't balance your checkbook by the end of the year, when you're trying to figure out your taxes, you're not gonna know all of that stuff. Sometimes I use credit cards to pay for things. And so what I do is for one, we balance our checkbook every account is balanced each month. And then for my credit card, when I go to make those credit card payments, and that's out of, say, your personal, I allocate every single charge on my credit card to a bucket. I use footnotes. So every charge goes to a bucket. So if I buy a closing gift on my Discover credit card, in my personal account, it will have real estate gift or whatever it is I call it. So that when I print my printout at the end of the year, my little bookkeeper can make a journal entry from this individual over here to my business. That way you capture all of that.
Okay, moving on, unless anybody's got any questions. How to pay my business taxes? Well, that's what Brian wrote. So I assumed what he meant was, how do I pay taxes on my business income? Okay. If you're an LLC or you're not an LLC, the answer is basically the same. You want to put aside about 20% of your income for later to pay taxes. Okay. That's just a general rule I give. I can get more specific, but generally I would just put 20% away. At that point, there's two different ways to handle that. You can just let that 20% accumulate during the year and then pay it all at once. Or you can make estimated tax payments. You may have heard the term, you're going to have to start filing quarterly, right? Okay, what that means is you're not filing a tax return quarterly. It means you're paying your taxes on a quarterly basis. The system is basically a pay-as-you-go system, okay? If you were a W-2 employee and you got paid twice a month, every time you got paid, they withhold taxes. So it's a pay-as-you-go system. And you don't have to make estimated tax payments. But the way your government works is that if you don't, we're going to charge you for it. So if you don't want to pay them 1 red cent more than what you owe them, pay them on a quarterly basis. Pay taxes in on a quarterly basis. And it's always best to overestimate than underestimate on your quarterly taxes. Don't worry, you'll get the money back. The more accurate you get out of it, you know, the less you'll get back, but that's better because you keep more in your pocket. Okay. So when I say quarterly, I mean, there's 4 different dates that they're looking for. All right. And it's not at the end of the quarter. These are weird dates. The first quarterly payment is due April the 15th. The second one is June the 15th. The third is September the 15th, and your last one is January the 15th. The last one is where you can catch up if you hadn't done before. Okay. A lot of people will have their tax return ready to go, figure out what they owe before April 15th, and make that their last estimated tax payment for that year, so that all their taxes are paid. But they'll wait to file until later. They'll file an extension and file the tax return later, as long as all their taxes are paid up front. Because an extension is only for filing, not for paying. Okay. So why would they want to do, why would you want to consider doing that? Because it's a timing issue with the IRS. Okay. If you file an extension because they're backed up behind, it's shaving off some of your exposure to audit down the road. Now, most people think that if you file an extension, that's a red flag, but that's the opposite is true. Okay, it's not a red flag. It's very common. I do 850 tax returns a year. 2/3 of them I do by April, and 1/3 I do as extensions. So none of my clients have ever been audited because they filed an extension. Been doing this for over 20 years, and out of all those years, I've handled maybe 6 different audits. So all this bull that you hear on the news about 87,000 new IRS agents are going to be coming after you, don't even pay any attention to that. There's no way they can hire 87,000 people. They don't have that. They don't have that capability. Number one. Number two, the funding for that's going to come over a 10-year period of time. So they can't hire 87,000 people. Right. Number three, they don't tell you. You don't hear this on the news because it can't scare you, right? It's not going to make you feel better. But over the next 5 years, they expect 50,000 of their employees to retire. So net, you're only up 37,000, not 87,000. Okay. So, and just, they are a mess right now. COVID really messed them up, and they they've hired high school kids. Based on some of the letters I've gotten from them, they've hired high school kids because they have no idea what's going on. Yeah, and you just send it in. You send it in with a form. I thought about doing a class on just how to do estimated tax claims because people mess it up all the time. There's a form that you can download off the IRS website, and it's called a 1040 ES. You can cut a check, fill out that form, and send that check in. What's absolutely critical is on the check itself, because invariably the check and the form are going to get separated at the IRS somewhere. On your check, you want to make sure that it has your social security number on it, the tax year you're paying for, and the form number that you're sending in, 1040 ES. That's very critical. If you just throw them a check, my name's Jim Smith. Here's some tax money. How in the wide world of sports are they going to know how to apply that? There must be probably 1 million Jim Smiths in the United States alone. So you've got to put your social security number on it.
Mike and I are there. A lot of real estate agents are female. So they'll put Michael Robideau in my social. Don't do that because you're not the taxpayer. The IRS will not know where to put that check. It has to be, when I send a check in, it's Mike's social.
Who's the taxpayer? The taxpayer is the first person listed on the tax return. It's the first person. Yeah, if she was the first person listed on the tax return, then she becomes the taxpayer and she would put her social security number on it. Even if she doesn't receive income, if she's the first name, that's what they look at. That's who the taxpayer is.
And I guess at the end, when you submit your return, the balance is wherever you are.
So, yep, you either underpaid or you overpaid, just like with a W-2.
Question is, how do you know that you're paying, say, $10,000? How do you do it?
Okay, it will go on your tax return. There is a spot specifically designated for your estimated tax payments, and it will go on your return and reduce whatever taxes you owe. Now, there's another way you can make estimated tax payments. You can make the payment online. Be careful. Very, very careful. If you want to make your payment online. Again, it's very, very important that the IRS be able to apply that estimated tax payment to the right tax year, to the right tax ID number, okay? And the right form. So just always check and double check if you want to pay online. So I had a client once that had a $30,000 IRS bill and he wanted to make a payment on it, not all of it, but he wanted to make a down payment on it, right? And they ended up draining his entire account for the whole amount because of the way he filled it out online. He was not ready for that. Yeah. Oops, I only wanted to do this. No, sorry. Yeah.
Right, filled it out correctly. He was on a payment plan. So I think he owed 45,000. He was on a payment plan of like maybe 1,009. You do a payment plan for 5 years or however long. And he did not understand the questions. And so the IRS took the entire 45,000. out of state. If I'll get that back.
Anybody else? So I got clients on both ends of the spectrum. I don't want to pay, I don't want to pay during the year, so I'll just wait and see exactly what I owe. And I'll pay that at the end of the year. Other people are just the opposite. I don't want to have to write a big check at the end of the year, so I'm going to make my estimated tax payments. So what's best is pretty much based on your personality and what you want to accomplish. You can say, I don't want to pay, but they're going to charge you penalties and interest for not paying on accrual. Yeah. You're going to pay 7% this year. It's a lot cheaper than your credit card interest. And some people put their, well, what's crazy is some people will put their tax bill on a credit card. I can't make this up. Because they're going to charge you a convenience fee for doing that. The government wants their tax money. And they'll put it on a credit card and pay 18% on it. Can't make it up. Tips for accounting. Kind of goes back to ways to save taxes. You've got to figure out a system that works for you to capture your data. We like QuickBooks because we can tie our bank account electronically to QuickBooks. And no matter the time of day or night, if something hits my bank account, it's automatically going to hit my QuickBooks. We use QuickBooks Online. There's a monthly service fee. It's cheap, in my opinion, because I always have access to my QuickBooks Online account no matter where I am, as long as I can get an internet connection. Number one. Number two, it's always backed up. I don't have to worry about doing my own backup, my own laptop or desktop PC to back up all of my data, because you never know when your hard drive is going to fail. And then they have to worry about the security. That way nobody can get into my account and muck around with Intuit. They're responsible for the security. So I don't have to worry about extra software that, to protect my desktop or my laptop so that people don't get into my personal business. That's why I like online. And then it may be $25, it may be $40 a month. It's well worth it in my book. Whenever a transaction comes into my QuickBooks from my bank account, all I need to do with it is put it in the right bucket, right category. It's simple to use until it's not, but you can always call for help. They've always got a helpline or something. Okay, so basically that part of the discussion was about being an individual agent. Sure. Home office deduction. If you have a dedicated room in your house that you use to do your business, which means you have a desk, you have a chair, you have file cabinets, things of that nature. You can't use your dining room table as a desk, okay? Then you can support having a home office deduction. And the way that usually works is, well, you got two choices. The simple, easiest way is to multiply the square foot by $5 per foot. So 120 square foot office, which is a 10 by 12, which is standard. Give you a little $600 deduction. The other option is to go actuals, which usually ends up being more than the $5 a foot. So you take your square footage of your office as your numerator, your square footage of your house as your denominator. That will render a percentage. You can take that percentage off of all your expenses for the house, anything on the inside. You can't take pool expenses and you can't take landscape expenses, but you can use your property taxes, your mortgage interest, your utilities, your homeowners association dues, your homeowners insurance, pest control, repairs. Huh? If you've got a housekeeper, you can use that cost as well. And whatever all those costs add up to times that little, usually 5%, you can deduct that on your tax return. You can do that either on Schedule C, or if you have an LLC that's being taxed as a partnership, you can do that. You can't do it if you're being taxed as an S corp. All your utilities. Even though the pool's on it, nobody's smart enough to know how much your pool is pulling.
Sometimes my daughter, she will help me in the business. So sometimes like I pay some money for her to.
How old's your daughter?
This is our favorite.
One of my favorite topics. I love this part. Yeah. All right, so kids are a great deduction. I mean, almost the best deduction on the planet. Okay. Especially the older they are, because the more they can do. So you get them to help you. Even, 5-year-olds, if they go to an open house with you, okay, that's a business expense. All right. So the way I like to explain it is, if you've got a kid, eventually sometime or multiple times during the year, you're going to take that kid down to Academy to buy them a new pair of tennis shoes. And they're going to go pick out the tennis shoes they want. And you're going to take them up to the counter and you're going to whip out that credit card and pay for it and walk out. And there's absolutely no tax deduction for that because we've done it over and over and over, right? If you pay your kid to work for you, and what I mean by that is you directly move money from your business account into their checking account. You've got to have a paper trail, okay? Then you can use their debit card to go out and buy that pair of shoes. And now you've got a tax deduction because you've paid your kid to work for you in your business. You've turned that transaction into a tax deductible event where before it wasn't. You're going to spend that money anyway. How can you make out a tax deduction? So you pay your kid and then use their money. Now, how much can you pay your kid? Right? So the answer to that question is the first $13,000 that you pay them in a year is tax-free to them. 13. That's the standard deduction for a single person. Okay? 13,000. So you get a $13,000 deduction. They don't pay any taxes. Win-win. Okay. They don't even have to know they have a bank account. Yes, ma'am.
I do this, right, from my business account, however, someone said like, bank statements aren't like records, right? So do I need to create an invoice of like, or a paid time sheet that I'm paying my children to have on to justify that transfer of money?
It's always a good idea to do that, just in case you ever get audited. If you don't get audited, nobody cares.
So then the second question, first 13,000, so like, I also have a sophomore in college, and I pay money from my business account to monthly. What if I go over the 13,000?
Okay, that was my next thing. Because it's one thing whenever your kid is not in school. It's a totally different kettle of fish when they are in school. Okay, so that's, I was about to get to that. Because you can pay your kid in school $30,000. And they don't have to pay taxes. And you get a $30,000 write-off. So how that works is you move the money over into their account. And then they pay their tuition, they pay their room and board. And like I said, like Holly said, they don't have to know they have an account. You know, most parents would not anywhere near trust their kid to pay the tuition. It's party time. So you can go in and pay the tuition from their account, okay? You won't claim them as a deduction. Oh, you lost $500. You got a $30,000 deduction on your tax return at 20%. That's a $6,000 reduction in your taxes. Easy to give up 500 to get 6,000. Make sense? Okay. So you won't claim them. They'll do their own tax return because now they're over the standard deduction for a single person. All right. They are going to get from the school a 1098-T, which is from the school showing how much they paid in tuition. As long as it's over $4,000, you're going to get a $2,500 tax credit. They are. And that $2,500 tax credit is going to cover all the taxes due on that $30,000. So that's why they end up having to pay no taxes. Because they're going to get the tuition credit, not you, because you're sitting there with a $6,000, favorable balance with your taxes, a reduction of $6,000 of your taxes, and they get the $2,500 tax credit. Right. Now, I say that. What I say at the beginning, here's the rule, and sometimes there's an exception to the rule. Okay, here's the exception to all that. You can do that all the way, and they don't have to pay any taxes all the way up until they turn the ripe old age of 21. At 21, they are now subject to self-employment tax on that money. Now, I had a client whose daughter went to Ole Miss. She joined a sorority. She was a cheerleader, out of state tuition, $60,000, $70,000 went to her. Okay. And we did all of that, reduced her taxes down to where she was really only paying taxes on 30 because she doubled up. But it still saved him more money because he got a $67,000 tax deduction at his tax rate of 35%. So you can see it still made sense for him to do it, even though she had to owe taxes. Right. She's still helping you save money on your taxes by being your partner. She can still be your partner. Yeah. It would not behoove you to claim them. It makes more sense to let them claim themselves. Yeah. And like I said, at that age, the only thing that you're gaining by claiming them is a $500 child tax credit. And you have the ability to save a lot more than that on taxes by doing that. Does that make sense? Sure. Okay, so, these tax rules, all of the tax rules are made by drunk politicians. I don't know why they won't allow it for an S corp versus a partnership. There's no rhyme or reason. There's no logic to it. So if you're in an S corp, no, you don't get an office in the home deduction, period. Anybody else? Did that answer your question? Yes.
Going to buy an iPhone. Is that part of the deduction or just the?
Absolutely. You can use it. Yes, absolutely. It's like going and buying a PC these days. Yeah. Credit card statements are, what the IRS wants to see is a receipt. Even though for every expense you've got on your credit card, you better have a receipt to back it up. Now, having said that, the general practice at the IRS is they're not going to ask you for a receipt for something that's less than $75. The exception to that rule is that they will want to see every receipt or anything travel related or meals.
So I have a scanner and I just scan every single little receipt and I put it in a bucket. Are 100% deductible and other meals are not. So I have a category in my QuickBooks, travel meals. Meals goes into that bucket and not my meals bucket. Meals is just, right? Okay.
Oh, yeah, probably going back to that. Yeah, 50 cents on the dollar.
Make sure that's separate.
Travel happens when you go outside of your tax home to do business.
And for the union.
So when you go to another city to do business, that's generally considered travel expense. So I get this question a lot. We want to take the family on a Disney cruise. And we're going to talk about real estate. Can we write it off? Okay. So the way the IRS wants you to handle that is that in an 8-hour day, how much are you doing business versus how much is personal? And you take the length of the trip and then you add up business hours and that ratio to total hours in an 8-hour day is how much you can write off. Does that make sense? Yes, sir.
I purchased a $300,000 motorhome. I read on,
Yes.
I have a property. And if I that we ask for later as well.
You can choose to either deduct the actual expenses or the mileage. But if you're going up there to check on your property, that's deductible. That mileage is deductible. Yes. And a lot of people write off their mobile homes as mobile offices. Okay. Yes, sir.
So you could buy a truck, should it meet?
I get that question almost on a daily basis. Okay. It's up to you. So here's the pros and cons. If you buy in your personal name, the only thing you have to worry about on an annual basis is getting that sticker replaced on your license plate, right? And doing your registration every year, and you can write off the mileage for your business use of it. If you buy it in the business name, okay, then you can take, depending on the truck that you buy, again, drunk politicians are involved. If it's more than 6,000 pounds, that's the line they draw to say it's not really probably a passenger vehicle. It's more of a work vehicle if it weighs more than 6,000 pounds. And so if it weighs more than 6,000 pounds, you can write off the entire purchase price of the truck in the year that you buy it. The downside is that if you buy it in the business name, then the county will have that information and they will tax you on your business personal property. Keller Williams has to pay taxes on all these tables and chairs that you see and all these desks and the TVs on the wall. They have to pay taxes on that to the county every year. So your truck will be included as business personal property. That could cost you $1,000 to $2,000 per year in county taxes. Now, the county taxes are deductible on your federal return. No. I've had the IRS come in and disallow that. You didn't buy that vehicle in your business name, you bought it in your personal name. Now, having said that, the 58.5 cents a mile on mileage includes about 25%, 25 cents of depreciation per mile. Yes. Scan copy is fine.
Thanks.
And there's lots of ways you can organize your scanned documents, okay? You can do it by month, and within each month, you can do vendor. You know, here's all my Starbucks receipts for the month of August. It's just one example. Or you can put all your Starbucks receipts for the whole year into one file. It just, whatever works for you. As long as you can produce a receipt that the IRS asks for. Okay? What else? Can you carry forward? In some situations, yes. So if your loss, if you had a net loss on your 1040, that will carry forward. Till it gets used up. I think the furthest you can take it is 20 years. Yes, sir.
That property I have in Michigan, I am paying a person $500 a month to live in it. How could I write that off?
Well, that sounds like a personal service to me.
Kind of is.
Yeah. So get a W-9.
Is it? The
W-9, get a W-9 from the guy. Because that's income to him. And you need to report that on a 1099 to him at the end of the year. And I would classify that something like outside services.
Like for the Airbnbs. The Airbnb paying the hotel and that tax for you personally responsible.
I'm gonna get into all that in the next section. That's one of,
Say it's Airbnb.
yeah. Okay. Any other questions on the personal non-investor level? Okay. Now, not exactly sure what Brian meant by investor. Okay, because that can be multiple different situations. And I put on here size matters. Okay, so if it's just you, are you going to invest in a piece of real estate that you're going to develop one way or another? You're either going to invest in this piece of real estate and you're going to rent it out. You're going to flip it. You could turn it into an Airbnb. Tax consequences and how it's handled on taxes is different for every one of those scenarios. Okay. First of all, he wanted to know, should we set up an LLC? If you're just going to rent this house out, you probably don't need to set up an LLC. Okay. If it's just you, all right. Anytime you get in bed with anybody else, I use that term figuratively. You'll want to set up an LLC. You'll want to have an operating agreement. You'll want to have a buy-sell agreement. Those things are expensive to get them done right at an attorney's office. Okay, you're looking at 5 to 10 grand, easy. Because they're not simple documents. There's no boilerplate operating agreement. There's certainly no boilerplate buy and sell agreement. Think about this. You want to go into a partnership with another one of your real estate buddies. and go out and buy a couple of houses and let's flip them. All right. And let's just say that other real estate buddy is married. You have no idea if this guy's going to drop dead of a heart attack or not. And now you're in business with the spouse. And you didn't want to be in business with a spouse. That's why you have to have a buy-sell agreement. Operating agreement sets out everybody's responsibilities, what you're responsible for, what I'm responsible for. And the consequences of me not fulfilling my responsibilities. And the consequences of you not fulfilling your responsibilities. So once you get outside of just me, it gets complicated on a legal side. And again, I'm not an attorney. I'm just telling you, I have seen partnerships bust apart. Best friends don't even talk to each other anymore.
Just set up a little company, credit whatever company, for several of these. Because 4 of the people who were married, 1 was not. And so I, as a spouse, had to sign a document that I am not part of that. So it's like, they pay me, I can't remember what it is, but I can't, I will not be a partner with them.
So there's just, it gets extremely complicated. Okay. You can set up an LLC certainly and put in your rental in it. You know, if you're really concerned about having another layer of liability protection between you and the public, you know, protect you from a slip and fall. LLCs are a little bit more cumbersome than buying just a run-of-the-mill umbrella policy. You're going to have insurance on this property anyway, but you can also buy an umbrella policy for like a $2 million umbrella policy may cost you $400. Cheap. It renews every year. Okay. You would definitely want to have an umbrella policy to cover you if you're in cahoots with anybody else. Yeah. Yeah, like I said, now some people have a rule of thumb that once you get up to 5 rentals, you want to put them in an LLC.